My name is Mark Dalliere. I'm head of hotels with Denton's law firm in London. I have four very distinguished panel members, all very experienced, come from a different perspective. So hopefully we'll get a nice balance of perspectives. On my far left, and I apologize, I don't have bios for everyone, so I'll just do a short introduction. On my far left is Eli Yunus. He's Executive Vice President and Chief Development Officer at the Residor Hotel Group. To my immediate left is Tao Zhu. He's Chief Executive Officer for Luneng Group Hotel Management Co. On my far right is Salim Bitar. He's CEO of Hospitality and Real Estate for Ojan Group Holdings. And to my immediate right is Philippe Bijawi. He's the Vice President of Development for Europe for Intercontinental Hotels Group. So thank you, gentlemen, for showing up. Just a kind of a ground rule, everyone's speaking not on behalf of their companies. That's to encourage an open dialogue, so please don't hold it against them. And also, questions from the floor are encouraged. We have questions that we'll go through, but please feel free to raise your hand and ask questions as well. That makes for a more interesting opportunity. So, Salim, let's start at a high level. As an owner, how do you think about a deal in a developing market that's different than how you might do it if you were doing a deal in Western Europe or one of the more established markets?
Mark, considering the state of the world we're in today, it seems like everything is a developing market. So we're seeing a lot of turbulence everywhere. I think very important for us, the first thing we would look at is an investor, hotel owner must look at what the investment strategy is. We've got to be quite clear on what that strategy is. Some of the things that we obviously have to look at is what is the competitive environment, what are the economic prospects of the territory, the jurisdiction that we're in, what is our hold period, exit strategy. All very important before we start the negotiations with an operator. I think because of that turbulence and the changes that we're seeing, do you want to enter into a rigid 20-year contract with an operator, 20, 30-year contract with an operator? Do you want shorter period? Is it possible to negotiate exit clauses in there before we even begin the negotiations? Do you want to share risks and rewards between operator and owner? So these are all some of the questions that you have to consider in defining your search for an operator, defining your strategy in terms of negotiating the management agreement. Nothing really different from the rest of the world, but it becomes hypersensitive as it gets into these developing markets because they change so quickly, and having a bit of flexibility in there, I think, is very critical.
Thank you. Philippe, you come at it from a very different perspective, the opposite side of the table, even though you're sitting next to Salim. Do you view or approach a deal in a developing market in a very different way than you would a more established market?
I think in developing market, we have to define a little bit what we define developing market versus mature market. We are in Europe. I'm responsible for Europe, so we'll focus on that region. For us, developing market will be non-UK and Western Europe countries. That's what I would define in Europe developing market because, and I think in terms of negotiation, the important issue is the education and the understanding of what the owner wants, what the project looks like, what he wants to achieve, and a management contract is not easy. If you think about it, somebody will say, okay, give me the key of your 100 million euro asset and we'll manage it for you for 20 years. It's not an easy conversation to start with. And what we have is to understand, like Salim just said, what the owner wants to achieve, what they want, and tailor-made this contract to their return aspiration. Most important is to explain a lot how a management contract works. That's what we do a lot in. When you say negotiation of management agreement in emerging market, is explanation of a management agreement in emerging market much more than negotiation because it's not an easy concept to digest.
Mm-hmm. Fair point. Eli, is your basic thinking any different? Are you going to be looking for a management deal? Would you ever consider a franchise deal in an emerging market, or?
I think we should elevate the discussion a little bit, if I may for a second. The deal-making landscape in emerging markets is different than the deal-making landscape in itself in mature market. And a deal is a deal at the end of the day, whether it's in New York or in Tokyo. But the landscape in itself is different. And I'll give you a few examples. From a relationship perspective, in emerging markets or in mature markets, let's start, you first do business and then you become friends. In emerging markets, you first become friends and then you do business. That's how it works. From an economics perspective, the whole landscape, economic landscape is different. There are no transactions in emerging markets. Hotels do not transact as much as they do in mature markets. The profile of your investor is completely different in emerging markets. There's much less institutional investors. The engagement of your owner is different. The way your owners look at risk and perceive risk and time is completely different. So all of those dimensions in themselves makes deal-making in emerging markets fundamentally the same, but technically in so many aspects different than doing deals in mature markets. Going back to your questions, franchise or managed, there is no rule of thumb. Every emerging market is different. It's the nature of emerging markets. If you look at Africa, for example, in today's world, you would mainly go for management contracts. There is no expertise on the continent today in Africa, really, to go for us to give our brands for somebody else to manage it. If you go to Russia, it's the same, but it's changing. The landscape is changing today in Russia. If you look at another emerging market like the Middle East, there the landscape is still more towards management contracts. And if you look at a emerged market, not emerging, like Turkey, there is much more franchise driven by the market than the management contracts, and that's the nature of the market. So there is no one rule of thumb that would fit every emerging markets. Emerging markets in themselves are very heterogeneous. There is no consistency among emerging markets other than they are emerging.
Thank you. Tao, I saw you nodding several times during Ellie's comments. What particularly resonated with you there?
I think in the developing market, the relationship is certainly important. But I think more important thing is the developing market. They are always looking at certain key components, the key components of the HMA, like terms or the most important thing I think is for the AOP is so important, the area of protection, because in a developing market, or particularly speaking about China, typically we call owning company or developer is the A side, operator we call B side. In China, it has been a B side market. And as I think Philippe mentioned, the HMA to certain owners or developers, it's a process of explanation of the HMA. So it's far from the equal negotiation level. So I think it's emerging market needed to catch up in terms of.
So you find yourself explaining the deals. Well, let me step back to what Philippe said. So you find yourself explaining the deals to the owners. How, given the basic balance in a management agreement, which for a new hotel owner, which I imagine in a lot of these emerging markets are going to be predominantly new to the experience of owning hotels.
Correct,
and dealing with the big operators.
Right.
How do you find yourself explaining the unique balance of risks and rewards that management agreements reflect?
Okay, I think I needed to give some explanation. Although my company name says hotel management, but I'm working for A side.
Yeah, okay.
It's a A side position. So we have some. That's why our company is bringing some outside people, the talent, with industry experience to deal with the operators, to understand what is the key component of the HMA. So that's put. I think now the Chinese owners and developers get more and more educated. Yeah, so that's the situation. Yeah.
Thank you. So, Salim, you mentioned that there's lots of different elements of a management agreement and lots of different aspects of the management agreement that come into play and need to be discussed. So I want to delve a little more detail into some of those issues. Let's talk about something basic like term. There aren't too many agreements that people run across outside our industry that have such long terms as hotel management agreements. So do you find in an emerging market that needs adjustment, or is it an education process, or is it how do you approach the term discussion in a new market?
I think there's first of all, management agreements and shorter term are like oil and water. They never really mix. You're absolutely right. I think, in particular when it comes to the larger brands, we are seeing an emergence of particular brands, not the larger ones, where there will be shorter terms that could be obtained. But I think if in emerging markets, you really want the brand, you want the distribution systems, you want that relationship to be a long-term relationship. So it's important to have that. However, it's also important to ensure, because of the turbulence that could happen, and because of the it's like a marriage. You don't know if it's going to work out or not after a few years. So it's important to have kind of a prenuptial agreement there, at least agreeing to what are some of these to have some exit clauses in there. So it's quite clear early on what will happen in case of a sale, or what will happen in case of big disagreements that will take place. So I would, from my perspective, I think it's going to be very, very difficult to move away from the 15, 20-year terms. But it's very, very important to also have those agreements ahead of time and ensure what you would do in such a situation.
So Philippe, what I hear Salim saying is he as an owner needs a lot more flexibility than the brands often are willing to provide. I suspect you see it a little differently.
I already heard that before, I think. Yes, of course, I understand the flexibility. I understand the need to be able to change your mind at a certain point when you sign a 15, 20 years management agreement. And I understand also the owner wants to be able to sell the asset unencumbered at a certain point eventually. Our approach would be like that. And I think that's one of the difficulties in emerging markets. A management contract can be terminated if the operator is not performing. I think it's a principle that more and more is widely accepted among my colleagues. I think Ellie, correct me if I'm wrong on that. I think it's a fair clause to have in a contract to say, yes, if it doesn't work, if we don't perform against the market, the operator can be terminated. Now, in case of sale, and my question is, okay, what the new owner is going to do with the hotel? Is he going to run it by himself, or is he going to contract another operator? What difference will be made with the new operator? So why should we be terminated in case of sale, unless there is a very good reason for this specific operator to be terminated? And this is where we need to find the right middle ground. I mean, it's all a question of balance, I think, in this type of contract, and understanding of where we need to go and what the operator needs to achieve. If we had a lot of contracts like this that could be terminated at any time, I think the commitment of the operator will be weakened and could be endangered. The difficulty will be in emerging market is, where do we compare ourselves against the market when the market is limited in some places? I'm not talking about Moscow or St. Petersburg or Istanbul. I'm talking about maybe new cities, Ufa, places where you have a limited number of, you cannot manage to get a ComSet even. So how do you compare yourself against the market in this condition? That's a challenge, and one of the specificity of the market, but there are also solutions to that.
I'm not advocating an adversarial position from the onset of signing an agreement. What I'm saying is exactly what you just mentioned, Philippe. It's very difficult sometimes to determine whether the operator has failed to perform or not perform. What I'm saying, however, it would be good to define what an exit would be early on, Whether it ends up being a performance is a separate thing, but it's really not having it's having an asset that is unencumbered at the time of an exit if required.
So, Eli, with respect to performance tests, Philippe alluded to performance tests, and he alluded to the fact that they can be a little difficult to implement in emerging markets because there are lots of thresholds that exist, 85% of GOP, 85% of RevPAR in the comp set. In a new market, that's a very dynamic environment. Are those good tests, or should we be looking at a different test or a different threshold than we might otherwise, in applying our normal rules of thumb?
Your best performance test in emerging markets is your relationship with your owner. Now, of course, you can contractually put whatever you want and to frame a certain or necessary performance by the operator. But if that relationship is not good, no matter what you have in your contract, it's not going to work. Or even if you don't fail your test, and if the owner wants to get you out, he'll get you out. That's the nature of emerging markets. And if you don't understand that part of the game, I don't think you should go to emerging markets from the first place, in my view. That's one. Now, second, contractual. This is details. I mean, granularly, yes, I agree. You can structure a contract that forms, that sets somehow the benchmark against which an operator has to perform. And historically, the benchmark has had two prongs. The monetary component of your budget, as you all know, and the other component is your market performance. Now, of course, if you go and open a hotel in Kazan or in Astrakhan or in one of those very secondary markets in Russia or in Africa, it's very difficult to benchmark. So this is where you have to be creative. If you insist, of course, on having those contracts to see how we can solve that. But for me, the most important part is, and I mean it because I've seen it, is that relationship with your owner. In emerging markets, much more important than in mature markets. I would ask first in emerging market, who is my owner, before I ask, what is my project? So this is how important that is.
Okay. Tao, I know you had some thoughts about performance tests. I'm trying not to be too granular, but you seem to have fallen into that, so be it.
Sure.
You had some thoughts about performance tests in an emerging market that may be a little different.
Right. Okay. I think the typical traditional performance test always GOP or the RevPAR, the certain percentage. So in emerging market or in some resort area, sometimes you are difficult to find your right appropriate comp set. So if that's the case, we go for the GOP. Go for GOP. But the one giveaway or takeaway or share with all of us is that never go for and. Is right, because Philippe is sitting here. Is if you do the two A and B, basically make the performance test easier, much easier, right? The lower bar always can safeguard the operator pass the test, right? We always insist or sometimes even just to take one, not even or.
How can you do that?
How can you do that?
This is where, as much as I love those relationships with the owner,
Yes, right.
you have to set things very fair from the outset.
So
Let's give you this example.
Okay.
Who's got kids in the room? Okay. So let's assume your kid goes to school and then you promised her, if she gets an A in math or physics or whatever, you will buy her a bicycle. And the exam comes, and then your kid gets a C, right? And then he goes and the kid comes and said, Daddy, I want the bike. He said, what's wrong with you? I asked you to get an A. So you get the bike. He said, no, but everybody got a D. And I got a C. That's as good as an A. So in this case, should your kid get the bike or not? I would buy her the bike, wouldn't you?
Yeah, but
There you go.
the difference. Yeah, but the difference is that the kids always listen to parents, but the operators they don't, right? That's the difference. Yeah. So my
I always
advice
told my
to
parents that the rest of the class
Yes,
get
yes.
I mean,
we work with IHG closely. Yeah.
This is how Eli explains it to the owners.
Yeah.
And I sign.
So advice to A side is always take one. If I know Eli is always against it, right? And then, for example, the resort area. For example, our company is developing a Ritz-Carlton in the a valley close to Sichuan province. It is very difficult to find appropriate comp set. So we will go for GOP. And then for the big cities, like first-tier city in China, like Beijing, Shanghai, or Guangzhou, Shenzhen, and you can just go for the RevPAR.
Jokes aside now, I think the problem with the GOP, and I don't like to get granular, but we have to now since that's the subject, is that you agree the budget is a guiding light. Nobody knows what happens during the year. Some of it is controllable, some of it is uncontrollable. Market dynamics in themselves are so uncontrollable. So many issues could happen, from currency exchange to all kind of market dynamics, to strikes at the airport, all kind of things, or misbudgeting. Sometimes owners push you to over budget. It's the nature of it. When was the last time you saw a budget going down? Tell me. It always goes up. But life doesn't always go up. That's the nature of life. We all know that as well. But budgets do always go up. So the issue when you just have a performance test only based on budget is that what if the market goes down and you still perform well vis-a-vis your market? What happens then? How fair is it in that case for Philip to lose his contract?
So one of the things, though, and I take the point, I think one of the things is an emerging market, it's presumably a market that lots of people are trying to get into at the same time. And so you're going to see lots of new products, in all likelihood, over a span of a few years. And that can throw a performance test out of whack very easily, because everyone wants to go to the shiny new project, the new brand, whatever. So if we've all concluded, or we've just at least recognized that there's a challenge in coming up with at least a two-pronged performance test that works in a market where it's difficult to get a competitive set, then, but at the same time the owner is looking for something, where's the answer? And I'm not suggesting anyone on the panel has it, but if you've got some suggestions, I mean, what's a good way to find a solution there?
Get an expert. Get an expert to come and evaluate the situation. Two experts. Has the operator significantly underperformed? Third-party opinion. What's wrong with that?
I like what Tao was suggesting. It is, look, let's face it, it's very difficult in emerging markets and developing markets to really define the competitive set, to define the performance of an operator compared to something else around. So I think it's critical to look at things that are important to the owner. Probably, considering the audience in here, we're probably going to throw eggs at us here, but the risk that the owner takes dwarfs by, ages whatever the operator is taking as a risk with the investment that the owner makes into the hotel. Now, what happens is an investor is we're looking for cash flow. We're looking for an improvement in the value of the hotel. So I think these are all elements that could be incorporated also if you don't go for the typical GOP, the traditional GOP test in a mature market. There are other ways to incorporate a performance test, and at the end of the day, it enhances and it aligns the interests of the operator and the owner. If you're looking, what does that mean bottom line to the owner? Sharing net cash flow, for example, instead of percentage of GOP as an incentive. So there are many different ways of looking at it that aligns what the interests and the objectives are of the operator and the owner when it's very, very difficult to year after year compare to something that doesn't really exist.
I have a question to my co-panelists here, owners. Before signing a management agreement, you do an operator selection, right? You don't go and say, open the phone book and say, I call IHG. You go, you look at, you talk to people, you do RFP process, you ask for proposal, you look at the system, number of the sales force, the brand delivery, the loyalty program, how many millions of members, all the distribution channels. You look at that, you do your homework, you do diligence, and you look at which operator can deliver the top line. Once you have selected your operator, you know which type of operator can deliver top line in a certain market and which one is less likely to deliver top line in a certain market. And this is where I would say, once you have selected this operator that has the ability to deliver top line, the only question is this operator able to deliver the bottom line then, and to manage properly the cost and the F&B revenue and all that, which is more local and more hotel specific. So all this process, I think, if in a mature market, is also very important, and you need to do hand in hand with the operator. In emerging market, you need, like you said, the prenup is even longer, and you need to really collaborate, build the project in such a way that it will last long, and the top line will be there, and the delivery. To fix bottom line, to be honest, is not a big issue. If you have enough skilled people that look at the way the hotel is structured, especially in emerging market. I mean, I don't know if somebody have heard, but I'm French. No, from the accent. Yeah, I'm coming from a beautiful country that has all kind of laws and taxes and all that. In emerging markets, the burden of employees is much lesser. Your bottom line is not going to dramatically change if you have one more employee or one less employee. It's not going to make a huge difference. So at the end of the day, when you have selected the right operator that is able to deliver the top line, the bottom line should follow quite easily. It really needs to make a major mistake in order not to deliver bottom line, unless it was at the first place a big mistake to have an hotel in a specific place in a specific market. That's a mistake that everybody will go. And like Heli said, I think very quickly the relationship will deteriorate, and everybody will take the conclusion that this should be a school or a hospital or a lodging or anything like that. But probably
so, Philippe, are you saying we should measure the operator on sales only then?
I think I mean, when you make your decision to go for an operator, look very carefully at their ability to deliver sales, deliver the top line, and if this operator is not able to deliver bottom line, why not have the option to flip to franchise? As an example, if you have the ability to bring a third-party operator that will be able to deliver the bottom line, if this operator is able to deliver the top line, you have a solution in your hand where you get the best of the two. You get the top line, you get the bottom line.
Let me just share a challenge. In mature markets, and I share it transparently, the operator's ability to deliver top line is highly technical. If you have a hotel in Stockholm or in Hamburg or in London, it depends on your system delivery. It depends on your loyalty program. Highly correlates to those parts of your distribution engine. In extreme emerging markets, it's much less technical. The success of your hotels is much more dependent on behavior. It's behavioral. Because it's the people on the ground and how you manage those people on the ground that is going to perform and pull the demand to your hotel. There's no GDS system that has enough phone calls to fill out a hotel in Astrakhan. If an operator tells you that, he's fooling you. It doesn't work like that. In those extreme emerging markets, the technical performance of the operator is not what drives the performance. It's the behavioral performance. And that equally should be part of how you select your operators. And that is the challenge, because it's very difficult to identify that from the outset. Silence.
Silence.
I have to agree with Eli, by the way. I think the partnership and the relationship that you create with the operator has to overcome the technical difficulties of putting together an agreement that makes the lawyers happy. At the end of the day, you're not in an easy market. It's not as simple, and I'm not saying it's simple in other parts of the world, mature markets, but the complexities of operating in the emerging markets. We operate in Mozambique, in Zimbabwe, in areas where it's very, very complex, and something as simple as getting visas for your employees or getting the approval to import particular products to the hotel. So that relationship where the two work together has to be very important. The owner has to play a very proactive role in being the person on the ground who actually facilitates doing business there.
Absolutely.
And this doesn't enter any of the agreements, the management agreements. So really, the relationship, while a brand is important, more important is what is the experience of that brand in those type of territories at operating and adjusting to the dynamics of those
And
markets.
the people. I mean, Selim and I, we do business together, and we have some hotels together. And that's a very live example. Yesterday, we had a technical issue on one of his hotels in Mozambique, in an emerging market. And we could have spent a year back and forth. It's a technical issue that's highly relevant commercially. We sat down, 15 minutes? And we solved it. And it boils down to these things in those markets. To those 5-minute meetings with your owners where you solve the issue that you have at hand.
I have to say that we spent about 3 months at headquarters, though, and it didn't get resolved.
Until we met.
So the personal rapport is very important.
Yeah.
So what I'm hearing is that, and not unexpectedly, is that it is very different doing business in one of these markets. So and I throw this out to the group, do the normal rules about how we set up fee structures apply, or should we be reconsidering those altogether? Normal, a base fee of a certain percentage, incentive fee based on at different levels. You mentioned something about NOI earlier, Salim. I'm sure others at the table would prefer something a little higher up at the GOP level. Does all this unpredictability, does all this requirement for good relationships, does it change how we talk about fees in a management agreement in a developing market?
The economic principle is the same. In any market you do, the owner takes his ownership risk and the operator takes his operating risk. And what you earn as an operator is based on a percentage of how much the owner makes. You do not charge owners unnecessary fees or fixed fees. That's at least our approach. And how you divide that and how you set those rates is highly dependent on a number of parameters, including the term of the contract, the performance, any termination options in the contract, area of exclusivity. There are far more dimensions that could impact how you split the cake between the two parties. But I think the fundamental economic principle, in my view, is the same.
It's not very different from mature market. In terms of fee structure in emerging market from mature market, I don't see major differences. Yeah, we have a base fee. Sometimes I hear, can you align your interest with the owner by having the change in the percentage of the base fee from 2 to 3 or something like that? It's already a percentage. It's an alignment by definition, because somebody 50 years ago probably had a fixed fee of $1,000 per room or something like that. We say, no, let's align interest and have a percentage. So now we have like a double alignment requirement. But I think it's okay. And to be honest, I don't remember this has ever been an issue. The fee structure. We always find a good balance between owners and operator in terms of fees.
Tabu?
Yeah, I think between the fees is one of the most important components in the HMA. Recently, I see more and more varieties in terms of fee structure. We normally see the tiered structure only for GOP, but these days we even see the tiered structure for base management fee. For example, the tiered means the timeline. First year is starting a little bit lower because you always have ramp-up years, right? So with base fee, we see several cases. The first and second year, the base fee is starting at a relatively lower level, while when it's stabilized, you can see like 2-3% of the revenue. And for incentive fee, we see some good trend in terms of from a side point of view, become a little bit more favored to the owning company side, because we see some cases in which owner's obligation is being taken consideration before the incentive fee is being paid out. I know Resdor or the IHG may they don't like to see this kind of trend happen, because you see the owner's obligation must be reflected in the deal. That's based on the both sides' understanding. If operator they can understand owner's obligation, I think they will be okay for owners paying some obligation before they get incentive fee. But we don't see that happen a lot yet. As I said, in emerging market, particularly in China, it has been much a B-side market so far. But now we see things are changing. Yeah.
I agree with Tao. I mean, I think it's typically, I think especially when brands are entering emerging markets, you get a contract, say this is our standard template. It comes, you have to negotiate with Brussels, not in your case, but or you have to negotiate with London or whatever. And at the end of the day, it's not really understood that there are, beyond the development risk and the cost of of construction risk and everything else that goes with it, there is the risk of the markets that is there. And it makes quite a lot of sense to really establish this kind of alignment. Again, I use the same word as before, and this kind of bringing the objectives together and as you're looking at the performance of a hotel. Owners' obligations are there to build the hotel. I mean, we've seen contracts that don't, and operations that actually don't start because the owner's obligations maybe are too big, and therefore we cannot even finish construction, or you cannot really complete some parts of the hotel, and therefore you just sit there waiting forever. So I think it's important to understand these risks and figure out a way where, in some cases, I can tell you for us, we've had 2 occurrences in the past 2 years where an operator has taken equity participation with us in some of these markets. They've come in at a minority, a 25% share, but they're there, and they at the same time got the management agreement. So this is a very interesting way, I think, of taking that approach and sharing in the bottom line. Another one, a live case that happened this year where an operator has not really performed in the last year. And we haven't reached the point of doing and completing the performance test, but they've come back and they've given back all their incentive fees that they had accrued throughout the year and said we want to give it up for 2016 because we're going to work very hard at ensuring that we will deliver results going forward. So I think these are the types of approaches where...
That wasn't us.
It was not Residor, yeah. You're too cheap to do that.
Maybe.
But it's 2 examples where we've experienced over the last 2 years in terms of, again, going back to the partnership issue and the relationship issue, where both of these have resulted in significant risk sharing and reward sharing.
Are there other ways? I mean, there are other ways that we're used to seeing in more developing or in more established markets to do that risk sharing. I think Tao referred a little bit to an owner's priority hurdle or something.
Right.
I think that's what you were referring to. There are other elements that people contribute up front as part of an inducement to do the deal, whether it's a guarantee or some kind of key money arrangement. Do those, and I'm not asking any one group here, do those make sense in an emerging market, or does it shift the risk profile too much to the operator at that point?
If I may answer this question, and then Eli, if you don't mind. What you mentioned about equity participation, it happened to be very difficult to structure an equity participation for one single asset even in a mature market is complicated. I mean, we've tried it a couple of times.
It wasn't a single asset.
No, okay. For a group of assets, actually, it makes sense and it could work. But for a single asset, it's complicated. So the solution, if you want to support a very good project strategically, and we have done it in the past, Hello. Oh, yeah, no, you can come in, please.
It was very difficult to find you. So many people are going.
It is.
We did not select this role.
I'm so sorry. We will give
Leads you the right direction.
the GPS coordinates next time.
That's because the HM always negotiating this kind of place, difficult to find.
So for strategic project, key money is a good solution to support, to show we share a bit of the pain, to support the hotel in the early days, especially because normally key money is paid on opening, where it's the most difficult always. At the moment of opening, that's where the cash is missing most of the time. So this is something IHG has done in mature and emerging markets for specific project, and it's okay. And it's not difficult to structure also, juridically speaking.
We do the same. Like, it's nothing new. Most operators do that today.
Bit too much.
Making some financial contributions in form of key money to secure projects. That is something that we would do also for strategic projects, of course. But we also do it in some key strategic identified continents, like in our case, Africa. And we just launched that a year and a half ago. Is sometimes take some very small equity participation as an industrial investor. We're not financial investors. We don't understand real estate. We have no time for that because you need the same amount of people to run one property as much as one real estate deal as much as 20. We're going back to what Philippe was saying. One single asset doesn't make sense. But in some key markets like Africa, we have designed a vehicle through our partners in Norwegian countries with the Nordic funds that are sovereign wealth funds in Scandinavia, where we would consider have 15-20% equity participation as industrial investors in key projects, specifically in Africa. So this is as far as we can go, but it has to be really strategic. I somehow I see when people believe that when an operator has an equity participation is sharing the risk, but there's so many other ways to also structure your deal commercially. So you increasingly align the risk, the interest between the owner and the operator without having a recourse to such risk-sharing model, because I have to say they are rather complex to put in place structurally.
So speaking about the key money, personally, I really against the equity participation. That's really make the deal complicated, right? You even cannot easily, stop your terminate your contract anymore, right? Because the operator really becomes your equity partner. So, but we can do key money is okay for operator to secure the asset, the project in the very desirable area or in a very desirable market. The key money is gone, is a one-time payment, but I think A side is the owning company or developer side can be creative in terms of how to get the key money. I'll give you an example. Our company has a project in Shanghai in prime location, and not IHG, but similar. It's an international brand company. So what we did is we structured the deal as of course the operator very keen to get the project, so agreed to pay key money, but we agreed to get the key money through the installment in the from 4th year to 12th year's management fee, the base management fee. In this case, I think it's a win-win. As the owning side, you got the key money, but as operator, they don't have a huge obligation to pay the huge key money lump sum up front. So I think we can always be creative to create some win-win situation for both A side and B side. Yeah, that's my addition.
So I'm going to come back to you, Tao, because you mentioned something earlier that I'm just going to shift gears here. You talked about AOPs, territorial restrictions.
Right.
Very important.
Right.
They're crucial in a developed market, but they seem like they could be even more important in an emerging market, because if you have the only really nice hotel in that market, you're necessarily going to be particularly damaged if another new hotel comes into the market.
Right.
So you said you like to, those become important. Do you negotiate
Yes.
them differently?
Yeah, I think AOP is also a very important issue, can also be creative. First of all, I'll give you an example. Shanghai, everybody knows Shanghai, right? And a very crowded market. Marriott, not even mentioning their potential merge already, almost a fact with Starwood. Without Starwood, Marriott in Shanghai, they have 24 hotels under their brand. Ritz-Carlton, JW, and Marriott, MEA, you name it. So in this kind of market, the AOP is a critical, right? AOP is a critical. So we quite insist on the very precise AOP. We can be creative as well. The AOP is not eternal, can be phased. Time. You can include the time element into the AOP. The first 5 years, before the hotel becomes stabilized, you want to have a relatively bigger AOP. But when your hotel get stabilized or get mature or even get famous, you can give away, after 6 years, 5 years, you can give away some AOP. So the AOP can, the time passes, you can have your AOP getting smaller. I think that's fine. So space and the time can be a good combination when you consider AOP. Yeah.
So I'm going to talk about something that I might get hit by Philippe and Elie on, but in recent years, across brand, AOP has just been something the brands won't discuss. And I'm not going to provoke them on that discussion. But in an emerging market, is it a discussion that maybe should be had, given that if you don't have as much product in a market, the market segmentation isn't quite there, and somebody's just going to go stay at a nice hotel, even if it's not at the segment that they normally might choose if they were in a place that had more opportunity and more choices?
We think it's very important to have this AOP. I agree also for a few years anyway, until the market matures, until your property matures, it's critical that it's not being challenged by the same brand in a nearby area. I can tell you, Mozambique is a perfect developing market example. We've negotiated something with one of our brands where we've got a countrywide, pretty much exclusivity with the right of first refusal. So if there's an opportunity and we're comfortable that this opportunity is there, we decide to participate or not participate, we can give the okay to proceed. Why? Because we have a plan to expand beyond our current portfolio. We are long-term investors. We've been there 16, 17 years, and we will be there for at least another 2 decades, if not more. So it's important that you're looking at what do you want to influence in the future, how much do you want your particular properties, especially these young ones that are just coming up, to be affected, and how do you protect them while at the same time not suffocating the brand and letting them potentially operate with other brands that they have, so they have that flexibility at the beginning. But then you've got to give that flexibility beyond a certain point.
Okay, thank you. Let me just see. Do we have any questions? I know we have about 10 minutes left, and I want to make sure we gave an opportunity to go to the floor.
Something about the AOP, may I say?
Of course. I'm sorry. I didn't want to put you on the spot there.
No, we're not on the spot. I don't know if you're aware, at IG we have franchisor mainly. We have 5,000 hotels, 800 managed, the rest franchised. And we have what we call the Owners Association. There is a global association, there is a European one, American one, and these Owners Association have decided that to create an impact policy for all our hotels. So whether we franchise or manage, every time we develop a new hotel in a given location, we calculate the impact. So I think that's the first step in the AOP. I mean, it's not like an AOP, it's not exactly the same, because we could decide and say and prove that a new hotel in the area will not create an impact for the existing hotel, but it's a sort of protection, and it's not unusual that we look at a new project and we say, no, there is too much impact on the existing Holiday Inn, so we won't do this project in this given location without even the existence of an AOP. Now, I understand the owner wants to protect his investment, and I understand the AOP, and like Tao suggested, when it makes sense and when there is the area is reasonable and the time scale is reasonable, we are willing to provide AOP. It's important to find the right balance as well between the AOP and the inability to develop the brand in a given market, because also the AOP could play against the owner himself.
Yeah.
If we're not able to develop and get the
Scale,
marketing power and the scale in a
awareness,
given market is worse than not having a second or third hotel in the same city.
The AOPs can be a devil in disguise for owners, and of course we would be willing, like Philippe was saying, to sit down and negotiate what is fair in terms of for an area of exclusivity. But you have to be very careful on how you do these things, because you may be hurting the owner's interest. In Tbilisi, for example, we have few hotels next to each other, and it's more protective to our owners to do that, instead of having a Radisson Blu next to a Crown Plaza, sometimes next to another operator. I'm giving examples here. Why? Because sometimes you better control the rate parity of the market. You avoid price wars in those markets if you control it. If the hotel is anyhow is going to be developed next to you, who is better off doing it? Now I understand the legitimate theory that there could be some dilution in your system delivery, and I understand that, but equally so, let's not neglect the fact that if there's another operator, in some instances, it may hurt you more as an owner than if it was the same operator managing this hotel. And that must be taken into the equation.
This is what we do by calculating impact.
Yeah.
Actually, see if actually we
In Copenhagen,
rates are.
as an example, we lease hotels ourselves. You know our background. We have a lot of leased properties still in Scandinavia. And we have 3 hotels leased within 500 meters. What's the impact? They all make a lot of money. All Radisson Blu hotels. We lease them. There's no owners. It's ours. Thank you.
Makes sense.
So I know from personal experience that one of the hot areas that gets discussed in every management agreement negotiation is the degree to which the operator is required to comply with the budget, or at least not exceed the expense side of the budget. You have to have some sympathy for the fact that costs are going to be inherently a little more unpredictable, a little more dynamic in a developing market. Is it still appropriate to try to really insist on full compliance with, again, not the revenue side, but the expense side of the budget? I refer that to either of the two owners.
When we measure the efficiency or the competency of the operator, I think owning company can using a very critical KPI, not regular, not normal like a labor percentage or those kind of KPI. We quite insist on 2 very important critical measures, which is revenue per staff and also GOP per staff. And some company always use room counts and the staff counts ratio, right, is the ratio. But I think this is not that efficient. The most key indicator is the GOP per employee. I really don't care about how much employee you have. The more staff you have, the better the service there will be, right? But on the other hand, if you don't measure the GOP per employee, you will lose the horizon. So I think the revenue per employee and the GOP amount per employee are the very efficient tools for owners to measure against the competency. And also, you can benchmark with other hotels, right? These are the 2 indicators to make sure operator, they not only be on top of the top line, but also control the expense side.
We pursue a very private equity type approach to our hotel investments. In difficult times, we had the markets we operate in have underperformed overall, but some of our assets or all of our assets actually have outperformed the competition that exists in the market. So from a revenue perspective, they're all down below budget in these areas affected by the economic turmoil. However, what we start looking at and what we really push and measure is what is the fixed cost, what is the break-even point in each one of these properties, and are they still delivering the service? Are they still delivering the satisfaction, the guest satisfaction, or are they not? So this is something very critical. You know, we don't really go and measure them by revenue or GOP by staff, but what's important for us is that we're seeing that this break-even point is becoming lean and mean while still having the ability to deliver the right service and the right quality in these properties.
And I'm mindful of the time. Are there any questions from the floor that people want to pose to the panel? Yes. Oh, good. Excellent. Multiple. Please.
One point that you haven't covered, referring to emerging markets and considering the current economic situation in some of these countries, what is the risk of the exchange rate fluctuation? And if it's the operator, how do you cover for that risk?
It's not the operator, I can tell you that.
The owner is the owner of the business. If the owner decides to invest his money or her money in Nigerian liras, then that's a risk. The currency exchange risk is on the owner. Now, what we as operators wouldn't do is to add a burden on the owner. So we take a percentage of the operating account. And if the operating account is in yen, we take a percentage of whatever yens there are in the operating account. And at the end of the month, we check what the exchange rate is on that date, and we press transfer. This is how accommodating an operator can be without causing any more risk burden on owners. Is that fair?
No, this is not bad at all. As a matter of fact, I can tell you that in some of the markets we operate, and the exchange rate devaluations have worked to our advantage. Why? The source markets and the guest mix is mainly incoming corporate type segment. These rates are defined in US dollars. A good portion of the cost of the hotels is in the local currency, so actually it has improved the profitability, the bottom line on there. Some of the accountants will tell you, yes, but the value of the asset has to be restated, or if you've got shareholder loans and there have to be restated, that really affects your balance sheet. It's true, but in terms of cash, it has really impacted us positively. And the smart operator is the one that can work and ensure that they could maintain the rates. We are driven by US dollar economy. So can they maintain that rate, or can they enhance that rate during these economic conditions? I have to, I'm not advertising for Residor, but they've done a very good job for us in the capital of Mozambique by doing exactly that.
There was another question. Yes, sir.
I'm not surprised no one has mentioned the technical services component. In emerging markets, it's often the first operator doing. Rightfully, often they give it to their wife to do the design. And I tell my clients the most important and valuable contribution you get from the management of the hotel is helping you design properly the right way and get it right from the get-go. I'm surprised that, frankly, the operators don't give that away for free. You fund it if the hotel opens on time and it's done right. It seems more a better incentive than, say, FEMA.
Can I answer that?
Happy to refund it. If you instead of on a key strategic project, instead of giving key money, I'll do that every morning. No issue.
No, I think you have to remember, with the technical services we provide, we save sometimes millions to the investors. Because we build thousands of hotels, and for this investor is the first one, the second one. So we have a bit experience on how to configure the project, where to place public areas where to have less sustainability, where to have less beams. And very often we manage to save a lot of square meters, a lot of and a few million. So I don't think the technical fee of 50 or 100,000 euros we charge per project is going to make a big difference in the economy of the project. On the contrary, I think it's a very cheap.
But it depends on the scope, Scott. You were in Russia. You know very well how extensive the service can be in place in Moscow or in St. Petersburg or anywhere in Russia. So in that specific market, as an example, because I know you know it very well, the amount of work that the operator has to put into it is really a lot, usually, because there's not much expertise in that market. If you go to Dubai or if you go to where you are based now or to another more developed technical market, then I think there is an argument. There is more argument in terms of the operator discounting on the technical fees. I agree with that. But if the operator is supposed to put 200, 300, 400, 500, 800 man hours into the project technically, then just let the operator cover his cost. Is it not fair?
I think there was one more question, and then I think we'll have to wrap up.
Questions, if you don't mind.
No? Go for it.
Both related to performance. The first one is, you mentioned earlier on that if the hotel takes it to the top, then the bottom line takes care of itself. Would the operators consider eliminating the base and management fee and get a higher incentive fee? That's question one. And question two would be more related to performance, another one related to performance. Typically, the management agreements have a clause that stipulates the amount of debt they can carry, certain projects. Would, if a hotel cannot service its debt, then would you consider that this is a non-performance, and hence the owner could eliminate or cancel the agreement?
Let me answer you. I would like to answer that.
Yeah, please. Be my guest.
Because I have live examples here. The first one is, yes, it's a numbers game. Look, if you don't want to pay any base fee and then double your incentive fee, I'm happy to talk. It's a business deal. Numbers are numbers. It's a pure numbers game. Let's sit down and fix it. I have no issues with that. So it's granular. It's technical. If it helps you have no base fee and significantly increase the incentive fee, I'm a businessman. I'll look into that, or with the team will. On the second point, I have strong views on that. I spent a year and a half. I've been in a certain part of the world for a good part of my career where debt service was never an issue. And I've been back to Europe now for 3 years. And for the last 3 years, I spent 20% of my time, meeting Erste Bank, Deutsche Bank, RBS, and HSBC and a few others. Because of owners having over-leveraged their properties at 80, 90%, and they are in trouble. And our hotel performing 20% better than the market, and the owner still having the guts, or the banker, to look at us and say, do something about it. And I was looking at them, we're 20% above market RevPAR, and it's because of your greed that we're now underperforming because the loan isn't work out. So I have strong views about the thought that if a loan is not performing, if a hotel is not performing on its debt, then it's the operator's issue. I think the loan is the owner's issue, and if the owner and the banker want to be greedy, it's their problem. It's as simple as that. Unless the owner wants to come to me and say, well, look, I'm happy to do a project with a loan-to-value ratio of 40%, 50%, 55%, and why don't you subordinate my interest component? I understand that. That's logical.
Yeah, we do it all the time. Most of the owner's priority return are structures like that to the debt service when the debt is reasonable.
Yeah.
Now, if the debt becomes unreasonable, it's impossible to align interest in that one. Just to say, I don't know if you know, but Eli and I, we used to work in the same company, Residor, only NHVS, so we know each other a long time. We had a situation where we had a contract which was a full incentive fee, And at the end, the owner came to us and renegotiated because it was so high that it became ridiculous. So he said, "Oh, can I have a normal 2/10 fee structure, please?" Because the intensity was so high that because we didn't know where the project will go. Of course, when you negotiate that, on paper it was a good deal, and so there is no rules about that. And at the end, the operator needs to be remunerated for his services, and the owner, which is taking the highest risk, should have the right level of remuneration.
But I'd like to ask a question. Why wouldn't you walk away from a deal if the owner is leveraging 80, 90% of the property?
No,
Why would you sign the deal?
At some point, because there has been a lot of, I have to say, Salim, we've had a lot of situations where we were told something and something else happened. Especially in 2006-07, when the financial liquidity in Europe was excessive. So everybody would tell you, yeah, no problem, 60-65%, and then suddenly you have 60-65% senior debt. In addition to that, 20% mezzanine, and top it up with convertible equity. And on paper, yeah, 60%. But if you add everything else up, it's much more than that. But you're right. I think operators should have the guts to tell the owners, if you want to put the business in jeopardy, I don't want to be part of that deal.
Yeah.
Absolutely agree.
Okay, with that, I think we've gone past our time. Thank you very much for showing up, finding the room. Have a good conference.
Thank you.
Thank you.
Thank you.